And with that, ladies and gentlemen, it is exactly 4:30 Eastern Time here in the Boston area. Please put your hands together and welcome our host and presenter today from OptionsMoneymaker.com. That's OptionsMoneymaker.com. Please welcome Mr. Mark Dannenberg.
Kevin, thank you for the introduction, and I appreciate everybody being here today. We're going to spend the next 60 minutes talking about the art of trading. This is all about harvesting more profits in less time and making use of weekly expirations. I'm Mark Dannenberg. I'm the founder and CEO of Options Moneymaker. My trading experience background includes over 25 years of trading futures, commodities, stocks, and options. For the last 10 years, I've traded almost exclusively options. That's all I trade today. I've taught hundreds of traders since 2006. I spent 26 years as a senior VP running divisions for a Fortune 500 company. I learned how to trade as a hobby during that period of time, and when I left after a great career, I decided I wanted to try to make it simpler for other people to learn how to trade and avoid a lot of the pitfalls that I stumbled through, avoid the learning curve that I went through for that period of time. So today I enjoy teaching people how to trade. I'm a trading coach. I'm also an active trader in the markets every day. Now, a lot of people will teach you how to trade. A lot of people will work with you, write books about trading, but they don't actively trade on a daily basis. I'm an active trader every day, and so are all the coaches on my team at Options Moneymaker. So we can talk with you real time about what's going on in the markets and real time about what's going on with the money that you have invested. We spend a great deal of time on strategy design. So we are constantly striving for simplicity, consistent profits, and to have fun trading. All right, that is what we are driven to do. That's what we want to accomplish. We like strategy designs that will allow us to take profits on a regular basis, get in, get out, not have a lot of stress, a lot of anxiety, allow us to adjust the position when necessary, and we like to enjoy our trading. So what I'm going to be talking with you today about is the art of trading. It is, hold on. Moving on to my next slide here. I'm going to talk with you about the art of trading and how a trader can be successful. A lot of traders get hung up just in the minutia of things going on and can't really see the forest through the trees. We're going to take a step back and we're going to treat this as an art form. We're going to realize that we can accumulate a significant number of profits, but we also have losses periodically. It's just the natural ebb and flow of trading. If you know how to trade successfully, it can truly be an art form and you can harvest profits. What I'm going to do today is to share with you one particular strategy that can be used over and over again in most any market. The target audience for today is really any level of trader. Intermediate to advanced options traders, except that even beginning options traders can apply the strategy that I'm going to be teaching you today and sharing examples with you. As long as you have the basic knowledge of the characteristics of options and you're familiar with diagonal spreads, which are debit spreads, calendar spreads, then this is a strategy that you may want to pay attention to. If you're interested in consistent profits and also if you're willing to break unsuccessful patterns. A lot of people I've met over the years, a lot of people that I've worked with have traded for a long period of time but never really gained consistent success. They keep striving for that level of success. I hope to be able to help you with some of that today. So our Options Moneymaker philosophy for winning is to trade strategies that win regardless of direction. Now, we don't always trade non-directional strategies, but we do trade a fair number of them, and they are our preferred strategies. However, part of the art of trading is knowing when to select the right strategy and being wise enough to select a directional strategy when there is an opportunity presented versus non-directional strategies when those are the right strategies to be using. We want to leverage the basic characteristics of options, which include the delta value of the option as well as the time value decay. We're going to leverage those basic characteristics as our primary way to make money out of the strategies that we use. We want to apply a simple, repetitive approach to our trading in order to optimize understanding of how to trade, understanding of what to do in certain situations. This is going to lead to a greater degree of confidence, and when you have confidence in what you're doing, you will have success. I think that one of the greatest challenges for traders today is not really understanding what to do when a position is in trouble, not really understanding how to turn a problem position into a profit. When you don't know and you don't have confidence, it causes stress and anxiety, and it tends to drive you to make decisions that are not in the best interest of your position. So we want to have success, we want to have confidence, so we spend a great deal of time ourselves and in our teaching helping to drive that level of confidence. When you repeat the same thing over and over and over again, it's like programming your brain, and you start to understand exactly how to manage that position, how to apply that position in any given market condition, and that will drive success. We want to trade small position sizes and compound frequently. We're not big fans of loading up the wagon and putting it all into one trade. We're big fans of taking very small position sizes, get in, get out, and compound frequently. And all of this is designed so that we can set aside fear and anxiety of the markets and have fun with our trading. If you don't enjoy what you're doing, you shouldn't do it. If you don't enjoy your trading, you should take a step back and consider why it is that you don't enjoy it and find ways to drive yourself to having more fun with it. I truly believe it boils down to what I said just a minute ago. Having a greater degree of confidence is going to drive a greater degree of success. So this is one strategy, okay? This is not the only strategy that people should trade. I don't think anybody should have a single strategy that they focus on. The market tamer is a strategy that is something Options Moneymaker, myself, my team have created. And again, it's one idea for successful trading. It's a relatively simple strategy, and it is available for all levels of traders. You have to invest a little bit of time if you're just starting out and understanding the basics of options, the basic characteristics of options. But once you've understood that, then this is a strategy that you could make use of. It has a relatively short hold time. You could trade 1 to 3 positions per week. Okay, you can trade longer term positions, but what we're really focused on here is trying to take our profits as rapidly as possible and taking advantage of the weekly expirations that are available to us. If you commit just 15 minutes per day to review your position, make adjustments when necessary, that's really the extent of the time that is necessary for you to be able to trade successfully. Now, how do I know that it's 15 minutes per day? It's simple. Myself and my team of traders, we have a 15-minute conference call every day to review our market tamer position. We review that position, and we actually invite our subscribers to come in and listen in as we are talking about what's going on in the market. So I know that we can cover that in 15 minutes because that's what we do every day. I'll talk a little bit more about that later. But we also like the market tamer because there's no significant charting or technical skills required. Most people are going to use either a fundamental analysis or they're going to use a technical analysis. If you trade indexes, there's no real fundamental analysis required because it's a weighted average of multiple stocks, the S&P 500, the NASDAQ 100, the Russell 2000. And so if you don't have to do fundamental analysis, you don't have to really do technical analysis, then it really makes this strategy a simple one and accessible for pretty much any level of trader. We also like the market tamer because when we need to make an adjustment, when there's something going on that is causing that market tamer to perhaps set us up for a risk, set us up for a loss, it usually can be adjusted to take care of that problem, and it doesn't require significant management. So those are a lot of the reasons why we like the market tamer. Market tamer strategy is designed to leverage the cycles of an equity. All right, so I talked about not really needing to use a chart or have good technical charting skills, but that doesn't mean that it doesn't take advantage of the fact that stocks and equities cycle up and they cycle down. Most people talk in terms of the trend. We talk in terms of the cycle. When an equity, an index is trending up, everybody's talking about how this thing's just going to keep going higher. We like to talk about how during the course of that rising trend, this index has gone up 30 points, then it went down 40 points, then it went up 25 points. We like to look at the cycles of the equity. We also take advantage of decaying time value of the options. That is significant to us. We like to sell premium and take advantage of the decaying value of those options. The market tamer is designed also to earn profits regardless of which direction the market may move, which direction the equity that we're trading may move. So again, it's good for traders who do not have strong charting skills. It's designed to be a short-term, high-profit trade. Now, does it make a profit every single time we put one in? No. But it is designed to be short-term, high profit. And so if you start trading the market tamer and you trade it on a regular basis, you're going to find that the accumulation of profits far outweighs the accumulation of any drawdown or risk or loss that you have on a position. And so it can be a strategy that you trade consistently in and out of on a week-to-week basis. Requires minimal adjustments, as I mentioned before. We have some pretty good guidelines around when to adjust. But all of that together provides us a strategy that allows us to trade basically eliminating fear of the market. We don't have panicked exits. We don't have sleepless nights. What causes fear for most traders is they open a position and then they have no idea what to do with that position when the stock or the equity moves against them. That creates a panic approach and exits. Most traders then will exit in a panic out of the position and have all sorts of justification about why they needed to bail out of that position. And they lose a lot of sleep. They're not enjoying themselves. It's no fun anymore. And so they disconnect from trading, which is unfortunate because if you apply a little discipline and you apply a little common sense and wisdom, and you've learned how to apply these things either by reading books, attending webinars, attending seminars, or hiring a coach, then trading can be one of the most productive, financially rewarding activities you can do. What I love most about trading is lifestyle freedom. It allows me to live where I want. It allows me to travel as often as I want, stay for as long as I want, and as long as I have internet access and access to a computer, then I can do the work that I want to do trading. So let me talk specifically about market tamer strategy. Again, it's one of the most consistently reliable strategies that you could trade. It's got some variations to it. What I'm going to walk you through is one very sound structure of it. All right. So this is not the only structure of a market tamer, but it is one relatively conservative approach to trading the market tamer. A market tamer position consists of 4 option legs. Okay, so there are 4 separate options that comprise the market tamer. 2 of them are a call debit spread, which is going to be basically a diagonal or a calendar spread. And the other 2 legs are a put debit spread. Again, can be either a diagonal or calendar spread. Now, the one requirement we have in opening this standard market tamer is that the stock or index that we're trading should be trading at or near the strike of the equity. So what I mean by that is S&P 500 is a good index for us to trade. The strikes on the options chain for the S&P are presented to us in 5-point increments. And so we want the S&P to be trading at or near one of those strikes in 5-point increments. And that is really the only requirement we have for opening a market tamer. You can use either monthly or weekly expirations. We prefer to use weekly expirations as they give us more of an opportunity to get in and get out and more rapid leverage of the characteristics of options such as the delta and the time value decay. So setting up a position on SPX, all right? I said we need to assess the index to see if it's trading at or near a strike. Just to give you some guideline around what that means is 1820.9 is near 1820. 1839.29 is near 1840. So it's a little bit subjective, but as long as you're reasonably close to a strike, an increment of a strike, then it's a perfect time for you to be able to set up the trade. Okay. Again, chart position is not important for the market tamers. And we're going to assume for building our example position that SPX is trading at 17.99. Now, I know today we closed quite a bit higher than that, but we're just going to highlight an example for you in this presentation. So setting up a position on SPX, a market tamer position, what we're going to start with is buy to open a call and buy to open a put. These are the first two legs of our market tamer. The expiration for our call and put are generally going to be 3 to 6 weeks out from today. So 3 to 6 weeks out from today, we're going to buy to open a call and buy to open a put. Both the call and the put that we buy are going to be at the money. That means if the index is trading at 1799.50, we're going to buy to open the 1800 call, and we're going to buy to open the 1800 put. So basically, we're buying both a put and a call at the money. The other two legs of the market tamer are going to be legs that we sell to open. We are going to sell to open a call, and we're going to sell to open a put. The expiration for these legs are generally going to be 1 to 3 weeks out from today. 1 to 3 weeks out from today. The longs are 3 to 6 weeks out. The shorts are going to be 1 to 3 weeks out. The one critical part of proper construction of a market tamer is that you want to have at least 2 weeks between the longs and the shorts. Okay? So you wouldn't want to open up the longs 3 weeks out and try to open up the longs 3 weeks out and the shorts 3 weeks out. You would want to leave 2 weeks between the longs and the shorts. All right? But what I'm giving you here is a range that you could open the longs and a range that you could open the shorts. Generally, a good rule of thumb for me is I'm going to be probably only selling 1 to 2 weeks out, and I'm going to be buying 3 to 4 weeks out. But this range of 3 to 6 and 1 to 3 is kind of the general guideline. Leave 1 to 2 weeks between the longs and the shorts, preferably 2 weeks between the longs and the shorts. Now, we're selling a call and we're selling a put. So we're going to sell to open a call that is 10 points out of the money, and we're going to sell to open a put that is 10 points out of the money. Now, I wanted to say this again. I said this a minute ago, but I just want to remind everybody. The example that I'm showing you here is one example of constructing a market tamer. This variable of being 10 points out of the money that can change. It could be 10 or to 20 points out of the money. It could actually be 5 points out of the money. And it may change depending on the stock that you're trading and the index that you're trading. The reason I'm sharing SPX with you is because it's one of the most accessible indexes for you to trade the market tamer. And a 10-point construction out of the money on what we call the wings, 10 points out on the wings is probably the most conservative and the best way to optimize the position. So with SPX trading at $17.99, now let's build our specific position. We're going to buy to open March week 1. Now we're past this, but remember, I'm giving you an example here. We're going to buy to open March week 1, 1800 call, and we're going to sell to open February 1810 call. Now at the time, we were in February week 2, so we were basically selling 1 week further out, and then we were pushing our long leg 2 weeks further out than the short. Okay, so we're going to buy to open March week 1, 1800 call, sell 10 points out of the money, the 1810 call, and using the same expiration on our long put, we're going to buy the 1800. And we're going to sell 10 points out of the money using the same expiration as our short call. We're going to sell the 1790 put. These are the debits and credits that will cost us and what we'll receive as credit in order to trade this strategy. The total investment risk, which is the net of the debits and credits, is $26.95. So it's going to cost us $26.95 per share to put this trade on. This position has the probability, likelihood of being profitable if SPX moves up, if it moves down, or if it remains flat near the current price. Time decay of the short legs, time decay of the legs that we sold out of the money, is the primary driver of closing the entire position for a profit. This is significant right here. It's the time value decay on the short legs that is going to allow us generally to close all 4 legs for an overall profit. Movement of the stock can also help to create profit, as well as fluctuations in the volatility of the index. But movement of the stock, fluctuations in volatility, along with time decay, is generally what's going to offer us an opportunity for a profit. So let's evaluate what can happen to this position if there is a move in the market. The position that we hold is the 1800-1810 call and the 1800-1790 put. So we've got basically 2 back-to-back diagonal spreads. If the price of SPX remains in a range between 1790 and 1810, this is a range that we refer to as the sweet spot. Okay? The sweet spot is that space between the 2 short legs. These are the legs that we sold. If we happen to carry this position all the way to expiration, and we were trading between 1790 and 1810, the 1790 put is going to expire worthless. Okay? If the index is trading above 1790, that put is going to be out of the money at expiration. It will have no value at expiration. And because we sold it for $12.05, it expires worthless. We get to keep the $12.05. The 1810 call, if the SPX is trading below 1810, the 1810 call will also expire worthless. We sold it originally for $8.30, so we get to keep that as profit. Now, what happens on the 1800 call and the 1800 put is that for the most part, they offset each other for no profit or loss. What I mean by that is when we open the 1800 call and the 1800 put, they both have nearly identical delta values. The delta value is giving us some idea of how much that option is going to change in value as the index moves up or down. If they start with identical delta values and the index moves higher, the put is going to lose money and the call is going to gain money. So you're going to have a profit on the call, you're going to have a loss on the put, and the loss and the profit are, for the most part, going to wash each other out. So when you open a market tamer, we make the assumption that we're going to have no profit or loss on the long legs. Now, the reality is, and I'll talk about it in just a minute, but sometimes you have slippage, which means that one leg is more unfavorable than the other leg is favorable. And sometimes you have what we refer to as traction, where one leg is more favorable than the other leg is unfavorable. But just to kind of understand the concept of the market tamer, we're going to assume that the long call and long put offset each other for no profit and no loss. So if we carry this all the way through to expiration, we are inside the sweet spot at expiration between 1790 and 1810. We basically make a profit of $20.35. We are closing out all four legs. We're selling to close the call and the put. Whatever the loss and gain on each leg is, they offset each other. And so what we're left with is harvesting the profits from the short legs. That means in what was just over a week, less than 2 weeks, about a week and a half, you have a potential profit of $20.35 on what was a total risk of $26.95. You're out of the position, you have all of your capital back, and you're ready to do it all over again. Now, let me just pause here and give you a realistic picture. I don't think I would ever hold a market tamer position, and I've been doing this for a long time, and I have created the market tamer strategy, so I'm very familiar with it. I would not hold it all the way to expiration. There are too many things that can happen leading up to expiration, the day before, 2 or 3 days before, that will all of a sudden potentially put your position out of whack. There could be a big move in the index, and all of a sudden, where you thought you were going to finish inside the sweet spot, you find yourself significantly outside of the sweet spot, and you're so pressed up tight against expiration, you have no opportunity to manage it, adjust it, and do anything that you otherwise might want to do with it. So my view of this is I don't need to have $20 of profit on $26 of investment. I mean, that's nice, but the risk is too great the longer I hold it. So there's no reason to be greedy. I'm probably going to exit out of this position, all four legs, for 10 to 20% profit. If I can get a 10 to 20% profit in a matter of days, I'm done. I'm out. And then I'm going to look for the next opportunity. And the next opportunity will probably have different expirations. It may have different strikes. I can constantly be trading a market tamer, taking profits when they are presented to me in the 10 to 20% range, and then look for the next new market tamer to get into. I would much rather do that, and I would advise you, if you truly want to be a successful trader, I would advise you to do that as opposed to holding on and waiting for every last bit of profit and time value to come out of those shorts. The longer you hold the position, the greater the chance that you're going to have to manage and adjust. Also, the closer you get to expiration, the more challenging that management and adjustment becomes. So it is wise of you to take profits in the 10 to 20% range when they're available. The longer you hold the position, also, The long legs are 1800 call and 1800 put. They have time value, and that time value is working against you. Now, it's not working against you as rapidly as the time value on the shorts is working for you because you have an extra 2 to 3 weeks to expiration on the longs. But the longer you hold the position, the greater the likelihood is that you're going to experience slippage on the longs. When they start to lose some of their time value, where the deltas get out of whack, that is where you start to lose some of your opportunity. So I would tell you, don't hold out for $20.35 on a $26 investment. Go for 10 to 20% return, then open a new position and get in at different strikes and different expirations. All right, so let's talk about what would happen if the index actually moved. We're going to arbitrarily pick a 25-point move. The average daily range of the S&P 500 is about 15 to 17 points. So a 25-point move would be a significant move in a day. And we evaluate our positions on a daily basis, so we have the ability to make adjustments on a daily basis. That's our time commitment of 15 minutes a day to review our position. If the price of the SPX were to move up, let's say 25 points, 1825, well, so what's going to happen to our 1790 put? Our 1790 put is going to expire out of the money, which means it will have no value. We sold it originally for $12.05, so we get to keep that $12.05 of profit. The 1810 call is closed for a loss of $6.70. Now, how did we end up with a loss of $6.70? Well, the 1810 call, when the index is trading at 1825, is 15 points in the money. That means it has $15 of intrinsic value. We sold it originally for $8.30. We now have to buy it back for $15. We net the $8.30 of credit that we took in when we sold it, and we end up losing the difference of $6.70. The 1800 call and put offset each other for no significant profit or loss. Remember, they both started out at the same delta level, and so as the index has moved up 25 points, the put is losing money, the call is giving us profits, and for the most part, they are going to offset each other. There are other factors that will affect the value and outcome of a market tamer position. Volatility is one of the most significant factors that can affect the outcome. And volatility is one of the reasons why we tend to trade our market tamers primarily on indexes. It's very easy to assess the volatility of an index. Now, it's not difficult to assess the volatility of a stock, but if you just happen to maybe be lazy that day and you open a market tamer on a stock and that stock is trading at extremely high volatility, it means that you're going to be paying more for your long call and long put. If after entering the position, the volatility were to evaporate, let's say it's trading at its 52-week historical high range, and then it drops down to the low of its 52-week range, you're going to lose value on both the long call and long put, and you're going to end up with a significant amount of slippage on those long call and long put. So there are other factors that affect it. What I'm sharing with you today is kind of the basic understanding of the market tamer. If you want to dig in a little deeper, we have ways for you to learn, all of the ins and outs of the market tamer. But I just wanted to pause here for a moment and talk about volatility, because when you're trading this on stocks, which it can work very well on, you have to be very alert to volatility. And even when you're trading on indexes, if volatility is showing a spike up, it's not the day that you want to be opening a new market tamer. You want to wait until volatility maybe has settled back down again. So back to our position, 25-point move up. We took a loss on our short call. We took a profit on our short put. We ended up with an overall profit of 535 on a 26.95 investment. So this is a situation where the index moved well outside of our sweet spot, moved 15 points outside of our sweet spot, and we still are able to harvest a profit of nearly 20% for being in the trade for a week. Again, I just want to repeat this. I would not hold this trade all the way to expiration. If we did, and we're a day or two away from expiration, and we think that we've got some more time value, we want to try to harvest out of the position, and all of a sudden it moved up another 25 points, that's going to be a losing trade for you because you didn't adjust the trade and you didn't close the trade and lock in the profits when you had the ability to do so. 10 to 20% is a good range, good target range to take profits. So the market tamer strategy is relatively simple. Now, it looks like an advanced strategy, and it certainly is more advanced than some other strategies, but once you start understanding how it works, it can be one of the simplest strategies for you to trade. It can be something that you could trade over and over again. You can trade in and out of it, sometimes as many as 3 times a week. That's a little extreme, but even if you were able to trade one market tamer a week, every week, 52 weeks out of the year, that's a pretty simple approach to trading. It's not the fire drill of running around trying to find something new. It's not the worry and anxiety of what did I do? What is the news telling me? What's going to happen in Europe? What's the economic calendar telling everybody? It's all about quieting all of that noise down and truly developing your trading as an art form. Now, I just want to say that I believe the market tamer is an outstanding strategy for this. I'm not saying this is the only way for you to obtain trading as an art form. It's one recommendation. If you have a strategy that you like and you hone your skills and you're very confident with what you're doing, and confidence to me means I know how to choose when to get in, but more importantly, I know what to do when it doesn't work out. I know how to manage that position, and I'm not just blindly bailing out, taking losses. I'm doing something about it so that I'm always managing my portfolio to a profitable outcome for each expiration period. That's our goal. We want to manage the portfolio to a positive outcome each expiration period. Okay? And it depends on how you want to measure that period, whether that's quarterly, whether that's monthly, whether that's weekly, however you want to measure it. Okay? But we want to have a big picture view. So the market tamer strategy is one where time decay is working for you even as the price of the stock is moving against you. So in this case, the index moved 25 points higher. It was 15 points beyond our short call. For some people, that would cause a little panic and worrying about what's going to happen. I'm in the money. What's going to happen with this? Well, the other reason for trading the SPX that we really like is it's a European style option, which means that exercise and assignments can only happen the day of expiration. So you can't get an early assignment on SPX. You could be in the money on your shorts a week ahead of expiration. You don't have to worry about whether or not somebody's going to unexpectedly call out your position, assign you, exercise their right to buy the index at the price that you sold that short for. The long call and long put offset each other. Okay, That's a beautiful part about the strategy. We've talked about slippage a little bit. We've talked about um, traction a little bit. We've actually, in the last couple of days, gained some nice traction on some market tamer positions we've had in play because we opened them when volatility was low, and we closed out one today for a real nice, I think it was about 12% profit we took today after holding the position just for a couple of days. And part of that was because volatility spiked up and it drove the value of our longs higher and actually gave us traction on the longs combined with time decay on the shorts. And this right here, this fourth bullet, is really the crux of it all. The direction of the movement does not matter. It doesn't matter if the index goes up or if the index goes down. All we care about is that we are in the position, we have 10 points out on the wings, we have a total distance of 20 points between our short put and our short call, and it allows us to then the luxury of saying, when I wake up in the morning, whether news is driving the market, whether emotion's driving the market, whatever's driving the market, if it stays flat, that's beautiful for us. If it goes up, well, guess what? We have just as much of an opportunity to take a profit as if it goes down. If it goes up a lot, we may have to adjust. If it goes down a lot, we also may have to adjust. But to us, it doesn't matter which direction it moves. The outcome is still similar. Successful trading, and truly the art of trading, is as much about managing and adjusting risk as it is taking profits. Now, we adjust our market tamers along the way. We're always, the expression I use is we're massaging the position along to expiration so that we can ultimately achieve a profit in the position. And sometimes we don't. Sometimes it ends up resulting in a loss. But we're okay with that because our profits far outweigh our losses on a strategy like the market tamer. The selection of the strikes and expirations that you use are going to help to optimize or diminish the opportunity for profit. If you open up a position where maybe you go out 1 week for your shorts and only 2 weeks out for your longs, you're going to end up with more slippage on the longs because the expiration is much closer to today. If you go out 3 weeks on the shorts and 5 weeks out on the longs, leaving that 2-week gap in between, that will probably still work out, except that now you've got 3 weeks before all of that time value is going to decay on the shorts, and the longs will still experience some amount of time value decay. I think the ideal structure of a market tamer is sell to open next week. So right now, today is Tuesday. I don't want to sell to open this week. I'm going to sell to open next week, and I'm going to buy 2 weeks further out. More than likely, I'm only going to be in that trade for 3 to 4 days. I'm not carrying it all the way to expiration. I only need to be concerned about slippage on the longs for maybe 3 to 4 days. That, to me, is an excellent quick hit opportunity. Sometimes the position needs to be adjusted. And a very simple rule of thumb, this is not the only way to do this, but a simple rule of thumb is once the price moves through the strike of the shorts, so when it moved above 1810, or if it were to move below 1790, you may need to adjust the position. Management techniques are equally as important in order to generate consistent profits. If SPX were to move 10 points outside one of the shorts, we're going to adjust the position to center it back at the money. Very simply, this is an adjustment where we're going to close the current position and we're going to reopen at the money. So on our position that we were using in our example, SPX had moved up to 1825. As long as we still had time to expiration, we're going to close the current position and we're going to recenter it at 1825. Our longs would then be 1825 and our shorts would be 1815 on the put and 1835 on the call. And the closer we get to expiration, the more rapid that time value decay is going to become. And so if we can continue to center the position, harnessing the power of that time value in our position, we have a much greater likelihood of closing out that expiration for an overall profit. I've already talked about volatility. Pay attention to it when opening position on a stock. Strongly suggest, if you want to trade the market tamer, that you trade the indexes. Start with the indexes, the SPX and the NDX. Those are two excellent indexes to trade. RUT is also an excellent index to trade. The market tamer works very well on stocks, but you want to make sure that you are relatively comfortable and confident with a market tamer, how to adjust and how to read the volatility before you get into the stocks. Take your profits in the 10 to 20% range, maybe even less. If you see the index moving a lot, if it's moved outside of your short and you have a 6% profit, take the 6% profit and do an adjustment. You can do an adjustment every day if you need to. If you could grab 5 or 6% every time, you're going to be pretty happy at the end of your month. Holding the position longer than this profit range is just going to increase the likelihood that you're going to have to manage or adjust the trade. So the art of trading is partly about your strategy, and it's partly about how you manage your positions. We like to start with a small amount of capital. Okay, we really encourage people to start with as little as 1 to 2 contracts per position. Now, maybe you think that doesn't give you enough of a profit per position, but if you take a look at regular, recurring, consistent success at 1 to 2 contracts per position, or maybe for you and your account, it's 2 to 5 contracts, whatever you're comfortable with. But if you do that over and over again, you recycle the same capital from the current trade into the next trade, you're basically continuing to harvest profits on that same capital. Close for your profits or adjust the position when necessary. But this is key right here, is compound your profits into each new position. You can continue to compound and grow the account substantially just by trading a small number of contracts. So as an example, if you were able to compound $5,000, you start with just $5,000 at 4% per week, and you just compounded that, meaning you made 4% this week. Next week, you're putting in a new position, and you're investing your $5,000 plus the 4% that you earned last week. Just a straight mathematical calculation tells you that that will grow the account in 1 year to $38,000. Now, that's a mathematical calculation. Real life doesn't quite work that cleanly, but what if you started with $5,000 and could grow it to $15,000 or $20,000? If you did this at 6% per week for 52 weeks, that number actually mathematically increases to $103,000. What if you did 6% a week, but you grew to $30,000 or $40,000 realistically? I think most any trader who has their